Welcome to the Scientific Sense podcast, where we explore emerging ideas from science, policy, economics, and technology. My name is Gil Eapen. We talk with world's leading academics and experts about their recent research or general areas of topical interest. Scientific Sense is an unstructured conversation with no agenda or preparation. We cover a wide variety of domains where new discoveries are made and new technologies are developed on a daily basis. We are most interested in how new ideas affect society and help educate the world how to pursue a rewarding and enjoyable life rooted in science, logic, and information. We seek knowledge without boundaries or constraints and provide unedited content of conversations with researchers and leaders who love what they do. A companion blog to this podcast can be found at scientificsense.com, and this podcast is available on over a dozen platforms and directly at scientificsense.net. If you have suggestions for topics, guests, and other ideas, please send them to info@scientificsense.com, and I can be reached at gil@eapen.info. My guest today is Professor Michael Roberts, who is Professor of Finance at the Wharton School of the University of Pennsylvania. His research spans corporate finance, banking, and asset pricing. Welcome, Michael.
Oh, thanks for having me, Gil.
Yeah, thanks for doing this. I want to start with your 2014 paper, A Century of Capital Structure, the Leveraging of Corporate America, in which you say unregulated U.S. corporations dramatically increased their debt usage over the past century. Aggregate leverage, low and stable before 1945, more than tripled between 1945 and 1970, from 11% to 35%, eventually reaching 47% by the early 1990s. That is a dramatic increase. When you see something like this, Michael, you think, this has to be taxes. I mean, there has to be some benefit for corporations to do that, right?
Boy, I'll tell you, every MBA undergraduate finance course would certainly point to taxes as the first place to look.
Yeah.
But ironically, I think if you actually spoke with CFOs, they wouldn't say it was taxes. Certainly not based on the survey evidence that one of my co-authors, John Graham, put together. And so while there's clearly a tax benefit to using debt when it comes to financing, it's really hard to find that effect in the data. And it's really hard to get CFOs to say that taxes are sort of a first order motivation for their choice of debt. Plus, when you think about it, taxes fell over that period by quite a bit, right? In the middle part of the century, certainly personal taxes, but I think possibly even corporate taxes, if I recall correctly, might have fallen quite a bit. So taxes aren't the reason for that big rise.
So what drove that?
Yeah, I want to be careful as an academic always, Gil, and sort of hedge my bets here. But I think if you put me on the spot, I would say it would be a combination of considerations, beginning with sort of productivity growth and economic expansion. Firms were just investing quite a bit more coming out of the war. And so, they needed funding for that. And with relatively low interest rates, certainly in the middle part of the century, debt was fairly attractive. So yeah, go ahead.
Yeah, is it so? So the managers of the firm, are they feeling that their firms are less risky because of the economic growth prospects, and that is what's causing it?
I think that's right. I think that's certainly in part of it. They see, look, we've got profitable investment opportunities. That's going to do two things. One, we're going to be acquiring assets that can secure debt, so that's going to help lower the cost of debt. But we've also got, optimistically thinking about it, good cash flows to support payments of the debt. And I think that combination is quite powerful in sort of defraying the cost of debt. You couple that with sort of this general aversion to equity financing that managers have for fear of dilution, whether it's rational or not is a separate issue. But debt seems to be the predominant source of external financing for companies. And with that economic expansion, it started taking up a bigger and bigger place in the capital structure of companies. That's certainly one reason. Yeah. There's another reason, though, Gil, that's actually quite interesting. Preferred equity used to be a much larger share of funding for companies at the start of the 20th century. And when you think about it, preferred equity is actually a lot like debt without the bankruptcy risk, right? You have to pay that quarterly dividend. And if you don't, you're in arrears, and you can't pay any dividends to common shareholders until you pay the dividends to preferred equity holders because they're senior. And so we saw this also interesting reduction in preferred equity issuances and sort of transferal to debt issuance as a preferred source of funding. So that's another mechanism that was kind of operating behind the scenes.
Yeah. So, when you talk to CFOs, earnings per share is a big metric. And if they want to maintain or increase earnings per share, stock buybacks and, really kind of reducing equity is a motivation. And so this seems like in that direction, right? One of the.
I think you're right. I think you're right, Gil. And I think your comment's particularly insightful because it raises a question, which is, why is there so much emphasis on EPS or earnings per share? In other words, this is something I go back and forth with my MBA students every year, many of whom come out of bulge bracket banks with this intuition, right? You don't like share issuances because it's going to inflate the number of shares, which is going to depress my earnings per share. That makes shareholders unhappy and prices fall. But when you think about it, when you issue more shares, you'll depress your EPS. But what you're also doing that I think people forget is you're delevering the company, right? You're reducing the leverage of the company.
Right.
And so that earnings stream is actually becoming less risky. So two things are going on here, Gil, that worked, right? You're reducing your earnings per share, but you're making that earnings stream safer. And so when we sort of link that back to shareholder value, things like stock prices, what we really care about, the impact on value is less clear.
Right. So in this period, 1945 through 1970, was there a desire is not the right word, was there a demand for more risky securities in the market? In other words, if firms, or deliver and, they become less risky, then if market is looking for more risky investments, they can find it. Was there a force like that?
It's a great question. I think it's entirely possible that maybe shareholder appetite for risk went up, and so they didn't mind buying into more heavily levered firms. But that, of course, begs the question: if I, as a shareholder, I want more risk, I can always, in theory, borrow money and sort of leverage on my own account. But that's theory. So you're right. That could be one reason. You know what else we found, Gil, that seemed to play an important role that really struck me as odd was actually the federal government.
Yeah.
And so, I walked into my colleague, Andy Abel's office. Andy's a macroeconomist here at Wharton. And he actually had a picture up on his screen, his computer screen. And I looked at it and it looked like the picture of leverage from our paper, whereas our leverage is sort of our picture, the line's going up over time. Yeah. His picture was going down right around at the similar slope and similar time periods as my picture. Yeah. What it was. And he said, that's federal debt to GDP ratio. That's debt to income.
Hmm.
And so what it set us down a path exploring was, it turns out there's this interesting substitution that investors are undertaking between long-term bonds issued by the US federal government, so treasury bonds, treasury notes, and really safe corporate debt, long-term corporate debt, so AAA, AA rated stuff. Yeah. And it turns out there's this interesting sort of crowding out effect that we found between government debt and private debt. So that's a third mechanism behind this sort of run-up that we saw in corporate leverage ratios. Because what happened was, right, the US government ran up a huge debt financing World War II. Debt to income, I think, reached around 120% at its peak in the 40s, but then gradually started paying that down, and the economy grew. At the same time, firms started issuing more and more long-term debt. And so that's really what we're sort of seeing, is a substitution of corporate debt for government debt in investors' portfolios, and that affects firms' capital structures.
Yeah, that's very interesting, Michael. So speculation is always risky, but we are coming back now. Government debt is increasing. Would we see firms sort of de-lever as we look?
Well, that's the question, Gil. And so what you're asking is, why haven't I extended my research, my paper, until today, which we should, and actually probably will. But we have to be a little bit careful. It's a little bit more nuanced, Gil. It's not that every firm will find it more difficult to issue debt in light of the increase in government debt issues. It's really the safest firms will face a slightly higher cost. And so it's a great question, and it's actually one we're going to be looking into over the next few months.
Yeah, so the safest firms, because they are a reasonable proxy to government debt from a risk perspective. So they are reasonable substitutes, and hence the crowding out effect, as you mentioned, would be affecting them more, right?
That's exactly right. That's exactly. Long-term AA, AAA rated debt is a reasonably close substitute to long-term government debt. And so it's a long-term safe asset, much like other studies have found short-term safe assets in the private sector tend to substitute with T-bills, short-term government debt.
Yeah. So the other factor also, Michael, I was wondering, when there is more uncertainty in the macroeconomy, in the markets in general, firms want to manage that uncertainty. They probably want to have more conservative capital structure, right? Also?
Absolutely. So on the one hand, right, if I see time, if I look forward in time and I see much more uncertainty, much more risk, two things are going to happen. One, I'm going to recognize that I may have difficulty paying down fixed claims, i.e. debt, in the future. It may be harder for me to pay down that debt. But remember, right, there's another side to that debt claim, and that's the bank or the bondholder. They're seeing the same thing that managers are seeing, at least as it pertains to the macroeconomy. And so what's naturally going to happen is the cost of that debt is going to go up. And so that the price mechanism is going to work to dissuade me from issuing debt possibly as well. So there's really two forces going on there.
Yeah, I can quite remember, Michael. I went to business school a long time ago. Is there a conceptual reason why we have this asymmetry of tax treatment to debt?
Gil, I'm chuckling because I think I get that question every single year for the last 20 years that I've been teaching this. And I keep saying to myself, I'm going to have to ask some historical accountant why that's the case, right? why did the government decide back in the, I guess it was the 30s or 20s, why did they decide all of a sudden that interest expense and not dividends should be treated as an expense that's tax deductible? And I don't have a good answer for that. I just don't know what the motivation is there. I don't know if it was simply inertia in how companies recorded or created their P&Ls, and interest was sort of above net income, whereas dividends were below it. So they figured, well, looks like an expense, we'll treat it as such. Or there was some better economic rationale at the time. But in hindsight, it's really bizarre, right? Because it creates this, perverse might be a little bit too strong, but it creates an odd incentive for not just companies, right? But homeowners, right? To use a lot of debt.
Right. Yeah, so if we were to eliminate that asymmetry, Michael, so what will happen? Would that have some beneficial effects in the economy? What do you see will happen if you were to one day eliminate that altogether?
Boy, okay. Well, certainly a lot of things would likely happen. It'd be hard to imagine that there wouldn't be any effect on corporate financial policy, even though I think the evidence suggests that tax effects on corporate leverage and capital structure are second order or relatively small compared to other considerations. For particularly highly levered transactions, and think about buyouts. So in the private equity space where a lot of debt is being used, that tax shield can be a big component of the value prop of a lot of PE firms and leveraged recaps. So clearly you get rid of that's going to alter sort of the investment dynamics and the financial strategies in those spaces. But then you also have to think more broadly. If we sort of zoom out from the corporate finance implications, Gil, we got to think about sort of the revenue that the government's taking in. And that's going to create a whole nother set of problems when it comes to sort of the national debt and deficits and where are they going to get that extra money. Now, all that said, Gil, I mean, at the end of the day, there isn't some nebulous blob paying these corporate taxes, right? It's you, me, and other shareholders. We're paying the taxes.
Right.
And so this is sort of a bizarre form of double taxation. And so then the question is, from an efficiency standpoint, and I want to be careful, I'm hardly the tax expert, but from an efficiency standpoint, why do the double taxation? Why not simply just tax the shareholders directly?
Right. Yeah, I mean, at least intuitively, that it seems like it'll be more efficient. It'll be less confusing at the very least. It will be, less effort in accounting and mechanical type activities. And private equity, as you mentioned, is also interesting. So if the returns to private equity is largely coming from this tax shield, as you mentioned, really sort of a financial engineering to optimize, has nothing to do with operating companies, but really just sort of financial engineering, taking taxes into account. One could argue that doesn't really add a lot of, real value to the economy.
Yeah, I think you're right. But on the one hand, that if it's pure financial engineering, it's unclear that there's a lot of social welfare or social benefit created. But I think we're doing I think you're doing a little bit of a disservice to private equity, and I have no dog or no bone in this fight, so to speak. But I think private equity does quite a bit more than just financial engineering. Number one, they do an enormous amount of work on the operating and strategic side of their portfolio companies. Number one. And number two, there's an additional benefit that comes with the use of a lot of debt financing that doesn't get as much attention, which is sort of the discipline it imposes on the company. There's just no room for sort of willy-nilly spending and free cash flow off to pet projects, right? So because you got to make those debt payments. And so I think private equity uses, to some extent, that financial strategy that's somewhat unique to them to help with their operational and strategic improvements in the company.
Yeah, that is true. So yeah, that's an interesting thing too. So debt is sort of a discipline imposing thing, and eliminating that completely may not be good
Definitely
for the firms themselves. Yeah. So I want to go into another paper that you have, the history of the cross section of stock returns. And you say, using data spanning the 20th century, we show that the majority of accounting-based return anomalies, including investment, are most likely an artifact of data snooping. When examined out of sample by moving either backward or forward in time, the average returns and Sharpe ratios of most anomalies decrease, whereas their volatilities and correlations with other anomalies increase. So what are the anomalies we're talking about here? Can you give an example?
So I'll give you just a little bit of backdrop to provide some context as well.
Yeah.
So a very large strand of academic literature, and one with particularly practical applications, is this notion of finding characteristics or signals that can lead to profitable trading strategies or generate alpha, right? And the idea is that I can make some investments and earn return in excess of what I should, given the risk I'm taking. That is alpha. And so this literature, which spans at least 50 years now, has found so many different signals or which include firm characteristics and sort of paths of past stock returns that seem to forecast future returns or identify strategies for which you can generate alpha. So to be specific, size, for example, right? There's this notion that small firms tend to outperform or earn higher returns than large firms. There's many other characteristics, how much a firm tends to invest or grow, how profitable a firm is. And so, right, the idea is that if you sort of sort firms along these characteristics, you get this really big spread in returns, whereas really profitable firms seem to earn high returns next year and less profitable firms, low returns, for example. And so what we did is we said, wait a second, it seems as if there's 100 different things that predict returns. Is it really that easy? And so what my co-author Jahani and I did is we exploited this data set that John Graham and Mark Leary and I collected for another project that went back to the start of the 20th century, before any of these papers had data or were written. And what we did is we repeated their analysis using historical data as sort of an out-of-sample test. And what happened is we didn't find anything. Most of these anomalies, as they're called, these sort of strategies that generate alpha, don't do it out of sample. So sort of the punchline of the paper, one of the punchlines of the paper is, it seems as if there's quite a bit of data snooping bias in a lot of these asset pricing anomalies. And I want to be careful. That shouldn't be misinterpreted as the author's doing something nefarious or wrong, just simply not having the luxury or not having done out-of-sample testing, which is just of paramount importance.
Right. And so let me see if I understand this, Michael. So there are many kind of specific things we can note, but more broadly, if we see a pattern during a period of time, that is sort of free alpha. So small firms, as you mentioned, as an example, let's say small firms have alpha and large firms have alpha, have no alpha. You could have a trading strategy that could capture almost free alpha looking forward, right? You could predict a portfolio's alpha by just using historical data. Now that seems unlikely, but I think what you're finding in this paper is that if you take a horizon in history that appeared to be true, right? Was that the
No, absolutely, that's right.
issue?
So you can find a world, a sample of data, and if I look in that sample, what I can do is to use the size anomaly, which has actually been going away as of late, but just for illustrative purposes. If I buy small stocks and I short big stocks, so I have sort of a zero cost portfolio, we like to say, because I'm using the money from the short to pay for the long. And that portfolio will generate a positive return over the next year. Yep. Right. And so there's many characteristics like size, profitability, investment, and on and on and on, whereby I can sort of form these zero cost portfolios and generate some excess return. And all we're saying is that, as soon as you apply those strategies out of the sample in which they were found, they seem to go away. Yeah. Now, to a statistician or a computer scientist who does machine learning or AI, this is obvious. Because you would never validate a model in sample, right? But by the nature, the virtue of the way this literature has developed, out of sample testing really wasn't emphasized, and it's getting a lot more attention over the last decade or so.
Right. Okay. I remember, Michael, there was a farmer-French idea, right? A small firm effect. And so did they actually find, even controlling for small firm effect, you still have some sort of inexplicable alpha?
You do. So farmer-French have had a number of different models: the 3-factor model, the 5-factor model. I'm not sure what factor they're up to now. But the whole point of I think the point of their story, though, is you have to be a little bit careful, is that it's not an anomaly in their view. Rather, what's going on is these are just additional risk factors. Smaller firms are riskier, and henceforth they should earn a higher return. If you think about sort of value growth, right? Value are riskier, so they should earn a higher return. And so whether they're an anomaly or their compensation for risk is, in some sense, a matter of perspective. I think the point we were trying to make in this paper is that regardless of your perspective, the sort of the validity of these returns or these alpha that these strategies were generating seems to be in large part, but not entirely for some of them, in large part an artifact of the particular sample in which they were found.
Yeah, like you say, it seems somewhat obvious, for folks who are involved in machine learning and things like that. It's always the case, overfitting has always been an issue. That's important there. But you also say in the paper, Michael, that a few anomalies that do persist out of sample correlate with a shift from investment in physical capital to intangible capital and the increasing reliance of debt financing over the 20th century. So the first point there, the anomalies that are persisting out of sample correlate with the shift from investment in physical capital to intangible capital. Can you talk about that a bit?
We look at a whole bunch of different anomalies. And while many of them, I think, can be plausibly explained by data snooping, a number sort of persist in sample and out of sample. And then that begs the question, Gil, of, well, why? What's behind these sort of persistent anomalies? What are the economics behind them? And it's actually really interesting. If you look at the anomalies that exist in the first half of the 20th century, they're closely related to real investment, physical investment. So things like investment in plant, property, and equipment, or inventory. But then if you look at the anomalies that exist in the second half, they have much more to do with profit and loss, P&L measures, things like sales and earnings. And so when we try and put these two findings together, why was one set of anomalies important in the first half of the century and another set important in the second half? You know, it goes back to the paper we were just talking about, Gil, the 100 Years of Capital Structure. It seems to be that when the economy was much more capital intensive, in other words, the economy was much more industrial, right? That's when anomalies predicated on things like physical capital and inventory, tangible assets, took hold. But as we moved into a more service-based economy, an economy based on more heavily on intangible assets, right? Intellectual capital, IP, brand, trademarks, these sorts of things. Then the anomalies seem to shift towards more P&L measures where, you know, sales and marketing and that type and R&D spend shows up. So that's the connection there between these sort of anomalies and risks with sort of the underlying economics of what's happening in the economy.
Yeah, that makes intuitive sense, Michael. I wrote a couple of books in 2009 in which I argued physical capital. If companies are investing in physical capital, that will have negative return in the future. Physical capital meaning dumb machines, right? Machines will become all the investments into smart machines are going to have returns, and I also argued human capital will have negative return because humans will be replaced.
Well, I think we're sort of seeing that play out, aren't we, Gil?
Yeah. So I want to ask you this. So we are sort of a regime change in the sense that just like you found a sort of a change from physical capital to intangibles, I think we are moving from what we used to consider intangibles into, it's kind of ironic. It is going to be physical in the sense that it'll be smart machines, right? So there is investments needed back into physical capital, but it's a very different type of physical capital. And companies who do a lot of investments into human capital, may find that difficult to do. So what? Just speculate a bit. Do you think that type of a notion is true? And if so, what do you think will happen?
I do. I'm not a huge fan of prognosticating or forecasting, Gil, which is why I'm an academic. But since you asked, I'll certainly play along. I think your characterization is accurate, but I think there's some nuance to it, right? That's probably in the background of what you're thinking, which is, I think the nature of the physical capital in which companies are investing has been changing. And so the plant, property, and equipment is shifting towards server farms and robots, automation, right? Which is, as you rightly noted, is replacing a lot of human capital. On the other hand, there's a different type of boom in human capital that needs to program and design that automation, those server farms, the programs that are going to run these robots. Now, I'll go one step further, which is what I'm currently seeing is all the programmers are starting to program themselves out of jobs, because pretty soon, I mean, it's already happening. In fact, I see it at Penn, at Wharton, as well as our engineering school. A lot of simple programming tasks are being accomplished by other programs, right? Programs are writing themselves. Another good example, Gil, is in the machine learning AI space. Programmers are basically automating machine learning pipelines. Now, right. I do get to stand get up on my soapbox for 1 minute here with the following. Having done applied research now for 30 years, over 30 years, I can say unequivocally that the need for human engagement in AI and machine learning will never go away, or at least it shouldn't ever go away, I think is a more accurate statement. Because what is incontrovertible is that the world changes, and it changes in abrupt and unpredictable ways, such that machine learning algorithms and AI algorithms that are so dependent upon data, historical data, and data up until a point in time, simply either can't deal with or struggle greatly to adapt. So we're not going to get rid of ourselves who do this work, but as you said, human capital is being replaced quickly and in spaces where we might not ordinarily think it would be replaced.
That's right. Yeah, I would have agreed with you, Michael, a few years ago. I'm sort of less convinced that humans will not be replaced. Humans are pretty problematic in many respects. Machines are a lot more reliable, and if you make them creative, they could do a lot better than humans. And we see this in engineering, as you say. We are increasingly seeing it in medicine, even areas like astrophysics and other areas where we think, sort of pure intellectual creativity drives discoveries and so on. It is beginning to taken over by machines too. And the other thing I want to ask you on the managerial side, I again argued probably incorrectly in 2009 that the principal agent problems we have in companies are getting worse. Agents tell the principals they are the greatest thing, but we have no data. There is no counterfactual experiment that basically says machines couldn't do any better. In fact, I argue that machines could do a lot better than senior managers of firms by first making random decisions and then learning from feedbacks. And so it is well, this is all speculation, Michael. It's unclear to me that we cannot replace humans in almost any job.
Yeah, so I don't know if I would argue too strongly against that, Gil. I may want to temper it with, until we can integrate some notion of ethics, and then that begs the question, whose ethics, whose morals, right? Things start getting really thorny, and I've got a bunch of fantastic colleagues in my legal studies and ethics department here at Wharton who are spending all their time dealing with these issues right now. I think we want to be a little bit careful before completely handing over the reins, because you're right, Gil. The machines can avoid a lot of the inherent biases that we humans carry with us.
Yeah. And
they can solve a lot of problems. But they can also, as we've already seen, create a lot of problems.
Create a lot of biases too. Like you mentioned, if you're training a machine learning algorithm using historical data, essentially, you remember Microsoft's Twitter girl. There was an incident in New York, an insurance company using a machine learning algorithm to prescribe the level of treatment needed for different people. And they found that African Americans required less treatment on the basis that they received less treatment in the past. And so, historical data that includes all the biases, if you use that blindly to train machines, we will just create very systematically biased machines. So
yeah,
that is a huge
it's
problem.
even more dangerous than that, because you could get a data set for which there is no bias per se, no discrimination behind any of the data, but because of the sample selection or the nature of the data, or existing limitations, that can actually inject bias into future predictions. So, there's just so many considerations. I sort of share your optimism, Gil, in the capacity for automation and machines to solve a lot of the shortcomings that we have as humans. But I'm also quite cautious and wary of sort of relinquishing control for some of the reasons we've discussed here.
I agree. And I think, like you mentioned, policy, there is a whole set of things that we haven't really spent a lot of time on. If regime change is going to happen, that is where I think we need to focus on. What would that imply for society? What would ethics mean? I've seen now how people react to machines when they see machines have feelings, emotions, and what does that imply for society? There's a whole set of issues. I want to touch another thing in the paper. So that second part of that observation was, again, anomalies persisting out of sample, increasing reliance on debt financing over the 20th century, as we mentioned in the first paper. So that is also a factor that appears to create these anomalies that
which again dovetails nicely with the other paper we discussed a moment ago. As the amount of debt in a relative sense is increasing over the 20th century, we see that financial distress is becoming an more important risk factor or anomaly, which again is consistent with sort of the secular trends we see in the economy.
Yeah, and these things have huge impacts in discontinuities, I would imagine, right? So 2008, 2020 type discontinuity will throw off the data.
No, absolutely. I mean, there's the data is littered with examples of periods in which these anomalies just get really, really out of whack. A good example is of the value growth anomaly flipped for quite some time. I can't remember the exact date, but needless to say, for investment managers or hedge funds following that strategy, it created real problems.
Right. Yeah. I mean, because of artificial intelligence and those types of things, now value growth seem to go back and forth every week, Michael. So I want to take a quick break, Michael. When we come back, we'll talk about your other papers. Thank you.
This is a Scientific Sense podcast providing unscripted conversations with leading academics and researchers on a variety of topics. If you'd like to sponsor this podcast, please reach out to info@scientificsense.com.
So we're back. Michael, we were talking about capital structure changes over time in the US and how debt has become a lot higher in corporations. And also stock returns, we find some anomalies in the past. Perhaps you argue it is related to overfitting of the data in sample. You have a couple of other papers, one of them related to what we were talking about. How does financing impact investment, the role of debt covenants? You say we identify a specific channel, debt covenants, and the corresponding mechanism, transfer of control rights, through which financing frictions impact corporate investment. So debt covenants basically these are things that when you take on debt, these are rules that the lender will impose on you, right? If you don't satisfy those rules, then there are some penalties around that.
Yeah, that's exactly right. So to make this more relatable, if anyone has ever taken out a loan or bought a home with a mortgage, just look at the contract. There's a whole bunch of things you have to do or rules you have to follow. Things you have to do, things you can't do. Like you can't set your house on fire. You can't do that. But there are a lot of these rules. They're called covenants, and we looked at covenants in debt contracts or loans, bank loans to firms, large corporations.
Yeah, and
they didn't get they hadn't really gotten a lot of attention. And what we wanted to try and figure out was, do these restrictions on companies actually affect what they do? So, we always think about shareholder governance, right? The board of directors and, their role in sort of keeping the company on track. Well, banks and lenders, there's a sort of creditor governance, and the way they execute that is through these restrictions. And so if companies violate these covenants, well, what the lender can do is they can come in and they can accelerate the loan, demand the borrower repay it immediately. Or they can cut off, if it's a credit line, like a credit card type borrowing, they can cut off the rest of the line to the firm. It's this really big hammer that the lender holds over the borrower if the borrower does anything to violate these rules. And what we found is that it turns out the lenders use that hammer in certain situations to make borrowers change their course of action. So what happens is when borrowers run afoul of their lenders by violating covenants, and to give you a specific example, when I say violating a covenant, borrowers are restricted in how high their leverage ratio can go. They're restricted in, how much liquidity they have to have on hand. And so if their leverage gets too high, for example, or their liquidity too low, that's a covenant violation. The lender steps in.
Yeah.
And so what the lender will have the borrower do is they'll have them quite often slow down their investment, spend less money. They'll have them borrow less money. So they won't let them borrow from other lenders. They won't let them borrow as much from their line, or they'll just ask them to slow down their borrowing. And so the net effect of this sort of oversight by lenders or this sort of control is that it has a pretty significant impact on borrowers when they start getting into trouble.
Yeah, so this sounds like sort of the firm losing flexibility. And in a world of high uncertainty, losing flexibility is going to be value destroying for the firm, right?
Absolutely. And Gil, it comes back to something you mentioned before the break. It's really all about incentives, right? The managers have one set of incentives that's arguably more closely aligned with shareholders, though there's debate. But regardless, their incentives are quite different from that of the lenders, who don't get any upside from the firm. They're just trying to recover their interest in principal. So the lender's trying to, with these covenants, these restrictions, sort of plot a path for the borrower that will ensure that the lender gets repaid. And when the borrower gets off that path and violates a covenant, in steps in the lender to reassure that they get paid.
Right. And so you argue here, if I understand this correctly, Michael, how the state contingent allocation of control rights can help mitigate investment distortions arising from financing friction. So you're saying in the covenant have sort of a set of rules that are based on future states of the firm?
That's exactly right. So what's happening is, I want to make sure your leverage, let's say your debt to EBITDA, your leverage ratio is 3x now, 3.0, 3 times.
Yeah.
I want to make sure that you don't get above 5. And so if at any point in time as this loan is going along, you reach a state of the world where your leverage spikes up above 5, I want to take control. I, the lender, want to take control and start making decisions. Now, of course, the lender doesn't literally take control of the firm. They effectively take control of the firm by saying to the managers, you're either going to do what we ask or we're going to make you pay all the debt right now.
Yeah.
And so think about it like this, Gil. If the lender didn't have that ability to sort of exercise some control when things went off the rails, either they're going to charge that borrower an absurdly high interest rate, or they're just not going to lend to them at all. So while this can be costly to the borrower ex post, sort of after things happen, ex ante, it allows the financing to take place and at a reasonable rate. Because I'm basically getting a commitment by the borrower to behave. Otherwise, I'm going to come in and they're going to be punished.
Right. Yeah, it's when things get really bad, though, Michael, at some point there is some alignment of interest between the lender and the borrower too, right? I mean, the lender could impose a covenant and essentially keep the firm and not get their principal back.
Absolutely, which is why these covenants are set in a manner to act as what Doug Skinner likes to call tripwires.
Yeah.
And so the idea is to try and catch the firm before it's past the point of no return, right? So when the firm trips the covenant, I can step in, look at the current status of the firm, take a close look and say, oh, this isn't a big deal. They had a temporary earnings shock because of, for reasons beyond their control, or it's just temporary. Yeah. And so I can just waive the violation and not worry about it. Or, this looks symptomatic of a long-term decline in their revenue stream. Maybe we need to start forcing them to pay back the loan early, or at worst, maybe we need, if they can't pay back the loan, maybe we need to step in and just liquidate this firm.
And clearly the lender doesn't have expertise to figure out what might be optimum investment strategy of the firm could be, right? So how do you mitigate that ex ante?
So that's the bargaining between the borrower and the lender. Right. The lender, in all these agreements, there's going to be some sort of limitation on their investment strategy, whether it's a hard cap on the number of dollars they can spend on CapEx, or it's just a simple limitation on diversifying acquisitions. You can't acquire any companies outside your normal line of business, for example. Mm-hmm. So they're very broad restrictions so that they're not trying to meddle in the optimal investment strategy or operating policy of the firm. They're just trying to box the firm in just enough to let them maximize value while limiting the downside to the bank. That's the key.
Yeah, so are you suggesting that rather than very specific ratios, financing ratios, maybe the covenants have to be more strategic in nature, or do I understand that correctly?
No, you're absolutely right. They're all strategic in nature, but they're trying to figure out or preempt all potential bad behavior by managers. And I say bad in the sense of not in the interest of the lender, right? Yeah. So let's think about what a manager could do acting on behalf of their shareholders, but that may not be in the interest of the lenders. They could take on a really risky investment,
right?
Which may be great for shareholders who benefit from all the upside, but it's terrible for lenders who only get the downside, right?
Yeah,
So,
or taxpayers, Michael.
yes, yes, you're absolutely right. Absolutely right.
Yeah.
So I'm going to think about all the different ways that a manager can take actions that can erode or eat into my credit, the value of my credit, and that ranges from paying big dividends to buying back lots of shares to making diversifying acquisitions to spending too much on capex to borrowing from other lenders. And so all of these different activities are all captured by different covenant restrictions in the loan document, right?
Yeah. Just thinking, Michael, if we had some bad experience in 2008 with bailouts of companies, should taxpayers be imposing covenants on companies taking excessive risk and coming back to Washington and looking for a bailout?
That's a great question. I'm not sure how you would implement that because there's no direct claim. So right. I think it might be a little bit difficult, but it's certainly something to consider.
Yeah. And the issue there obviously is sometimes firms say, yeah, we pay the money back. The problem is the money was given to these firms when they were in really bad state, right? Mm-hmm. And so the return on that investment for taxpayers have to be a lot more than 1% or 2%.
Yeah, that's absolutely right. Look, I mean, this is the fundamental idea behind finance, and that's risk and return. Yeah. You want me to take more risk, you have to offer me more return.
Yeah. Hopefully we won't have a repeat of 2008. So I want to finish up with your more recent paper, CLO Performance. We study the performance of collateralized loan obligations to understand the market imperfections giving rise to these vehicles and the corresponding cause. So what exactly is a CLO?
Sure. So a CLO, or collateralized loan obligation, is a securitization. So that's just another big word. Let me explain it really simply and briefly. What you do is you get an individual who decides to buy from banks a bunch of their loans. Okay?
Yeah.
And the way this individual is going to buy those loans is by raising money from investors. But rather than raising money from one group of investors per se, like a mutual fund, right? I give money to a mutual fund to go buy stocks in some sense.
Yeah.
This individual, the CLO manager, is going to get money from a bunch of different groups of investors, all of whom have different claims on that pool of loans that he's buying or he or she is buying.
Bit like mortgage pools.
Yes. So very, very similar. So instead of buying a bunch of mortgages, I buy a bunch of commercial loans or leveraged loans. But the trick is that the way I buy them is I issue what are called tranches. I tranche the securities, which means part of the money comes from investors who get a AAA rated debt security. And then some of the money comes from investors who get a BBB rated security. And then other investors who get a B, and finally equity investors. And the whole idea is that as those loans, Gil, pay interest and principal, I give money to my investors in a very strict order. I give it to the AAA debt holders first, then the BBB, then the single B, and then the equity if there's anything left over. And so as loans start defaulting, as they did in March 2020 or 2008, what happens is the amount of money I have to give to the investors is smaller. And so the people at the bottom of the totem pole, the equity investors and the B-rated note holders, they lose out on money first.
Yeah.
Okay. That's what a CLO is. That's all it is.
So, so this is sort of a business structure. So I guess there is some diversification benefits here. You can go get a large number of loan obligations, and you could have some risk diversification benefits here too.
Yeah, I mean, there is a little bit of diversification, but there's also loan mutual funds around, so I can get exposure to the same pool of assets just through a loan mutual fund. I think the real value that these vehicles are providing and the impetus for them comes from the difference, the different interest rates I have to pay on that the loans are paying. In other words, the money I'm getting from the loan pool versus what I have to pay to the AAA note holders who are the bulk of the financing. And so there's a lot of extra interest that sort of trickles down the liability structure of these vehicles to equity holders. And that's that's primarily what's going on. It's akin to an arbitrage of interest rates.
Yeah, so you say here that CLO equity tranches earn positive abnormal returns from the risk-adjusted price differential between leveraged loans and CLO debt tranches, rather than your skill in selecting and trading loans. And so, if I understand this correctly, Michael, the entity that was holding these loans initially is selling those loans to the CLO manager. Mm-hmm. Either that entity does not have the skills and information to extract this abnormal returns themselves, or what else is going on?
So what's it's actually quite interesting. So the banks are originating these loans, right? Yeah. I mean, the banks are originating the loans, but they're originating them with a group of lenders, called a syndicate. So other banks, other institutional investors. These loans, these little loans, pieces of these loans, they trade in a secondary market. Okay. So the banks are getting the loans off of their balance sheet. Why? Because they're risky. They come with high capital requirements. Okay. So the banks get them off their balance sheets. Then the banks turn around and buy the AAA rated debt securities that the CLOs issue.
I see.
And so what they're doing, it's quite fascinating. When you think about it, they're getting the high risk loan off their book and replacing it for a low risk AAA rated security.
So it's sort of getting around the regulatory requirements in terms of capital.
You got it. That's a big role. It's a sort of form of regulatory arbitrage on behalf of the banks.
Yeah. Yeah, it's interesting. I mean, but they're losing something. If the CLO manager is having reasonably high abnormal returns from those structures, presumably that's a return that the banks could extract. Right?
Yes. So the question is, why are the banks doing that? But I think this comes down in part to a sort of regulatory arbitrage. It's less costly for a bank to hold that AAA rated security than that B rated loan, right? In terms of the capital that they have to hold. So that certainly plays an important role. The other reason, though, is just the demand for safe assets, AAA rated securities, right? This comes back to the first paper we discussed. The demand for safe assets is such that there's a premium for a AAA rated security. And so that whether it's because it's not liquidity here, but whether there's some sort of a convenience yield, whether it's a money-like instrument, whatever it may be, that drives up the price of those assets and hence down the yield. So that's yet another rationale for this sort of wedge between the interest coming out of the assets and the interest they have to pay to the liabilities.
Right. Yeah. So in conclusion, Michael, we talked about a lot of intermediation between different types of assets, loans, debt, CLOs, and so on. Do you see this intermediation more broadly? And I'm putting investment banks in there, I'm putting private equity firms in there. Do you see, as we look forward, the need for intermediation declining or getting replaced by technology?
So that's a good, it's a good question. Certainly, we're already seeing technology replacing intermediation to varying degrees in existing structures, right? I mean, just log on to your retirement account. A lot of that is technology from advising and offerings. But in terms of a reduction of of the intermediary space, I'm not so sure that that's going to be reduced. It's certainly changing form from a very bank-dominated sector in the first half of the 20th century to a much more non-bank sector. I mean, if you think about private equity, if you think about the large private equity firms, Gil, they don't just do buyouts, right? They're full-fledged intermediaries. I mean, they've got real estate holdings, they've got credit desks, they're running CLOs. So, intermediation in its broadest sense is so much larger than banks. I think we're seeing a real change or dynamicism in the form and structure of intermediation, as opposed to necessarily a reduction in the size or scope.
Yeah, that makes a lot of sense. Do you think there will be this will lead to more participation, or like you said, different types of companies coming into the arena?
Absolutely. I mean, right, when people talk about fintech, isn't it just that? Right.
Yeah.
Look at, it's interesting. I was talking to someone at one of the bulge bracket banks. One of some of their biggest competitors now are the tech firms, Google, Apple. Yeah. So, what intermediation is changing, and who does it is changing dramatically.
Right. Yeah. And going back to what we were discussing before, there is probably some need for really thinking about regulation a bit more differently, right? The past is not a good proxy of the future is going to.
I think you said it perfectly, Gil. It seems as if regulation is always one step behind practice. Yeah. And that's going to be a challenge that I don't think is going to go away, but we'll see.
Yeah. Robin Hood is the latest phenomenon.
Yeah, I'm not. That's an odd one.
Yeah, excellent. Yeah, thanks so much for spending time with me.
Oh, the pleasure's been mine. Thank you so much, Gil.
Thank you.
This is a Scientific Sense podcast providing unscripted conversations with leading academics and researchers on a variety of topics. If you'd like to sponsor this podcast, please reach out to info@scientificsense.com.